I think we'll get started. Good morning, everybody. We're delighted to welcome you all to our webinar this morning to look at alternative funding options for international growth. I'm Cillian Cawley, Trade Director for Ireland at OCO Global. And what a year 2020 has been so far, with COVID-19 having had an unprecedented impact globally, and Brexit is the present that keeps on giving. Despite all these challenges, Irish companies continue to look positively to the future and are looking to international markets for growth opportunities. Access to suitable funding is a major issue for companies seeking to grow their business through exporting. And over the next 45 minutes or so, we will look at alternative funding options which Irish companies can access to help finance international growth. This morning, I'd like to welcome our speakers. First up, Gareth Hagan, Deputy CEO of OCO Global, who will share practical guidance as to how Irish companies can access and maximise international business opportunities. We're joined by Luke Mooney, Director for Ireland at Duff Phelps, who will provide a brief overview of funding options available to Irish companies. And our special guest speaker this morning is Henrik Björklund from Proventus Capital Partners, who are based in Sweden and have made significant investments in Irish companies in recent years. Henrik will look at non-dilutive alternative funding options and discuss how Irish companies have already accessed growth capital. So please sit back and enjoy this webinar. We'll be having a Q&A session at the end, so I'd encourage you please to use the chat function during the webinar, and please send through any questions you would like to ask. And we'll start now with Gareth, and Gareth now will start his presentation. Thank you.
Morning, Cillian. Thanks for the introduction, and good morning and welcome to everybody on the webinar. Really appreciate you taking the time with us this morning. I suppose I'm a little bit of the warm-up act this morning before I hand over to the money men in the shape of Luke and Henrik. But I'd like to just take a couple of minutes just to introduce the firm, OCO Global, talk a little bit about the services we provide, and maybe even sort of make the dangerous kind of move of trying to predict and trying to bring some sense to what's been a particularly turbulent kind of economy over the last 5 or 6 months. So firstly, if I could just talk about the firm, OCO Global, if I can just get the slides to move on here. There we go. So OCO Global, we're an Irish company. We're dual headquartered in both Belfast and Dublin. And I suppose unlike other advisory firms, we have a very specific range of services and a very specific mission, namely that of supporting international business growth. We do that, as I mentioned, via the offices in in Belfast and Dublin, which allows us to be very close to kind of our customers in Ireland. But we also, as you can see on the slide, run an international network comprising 10 or more offices around the world. And as you can see, we're present in all of the main markets in which you're likely to want to do business. We have a team of about 100 people, that sit in each of those offices, and typically are comprised of folks who've got, specific regional or sector expertise. We put that to work, for the benefit of our clients, along with a network of delivery partners, consultants across the world. So what is it we do, really? I mean, people ask me this question a lot, and I suppose we're a little bit different, to the classic advisory firms that you might be familiar with, in that we do kind of the classic consulting, I suppose, around international strategy in our case. But increasingly, we've adapted and we've expanded our service offer to meet the needs of our customers. So in the last couple of years, that's taken us into doing an awful lot of work around transactions and cross-border M&A. And obviously, we'll talk a little bit about that in the funding sense later on in the presentation. But also, as well as being advisors, we're a particularly practical firm, and we provide practical operational support across the world. That could be outsourced business development, it could be helping you to find delivery partners, or indeed it could be acting on your behalf while you scale your business internationally. And we occupy an interesting space, and I think a space that will become even more interesting as we kind of get through and hopefully out of the pandemic, in that our customer base spans both companies and government. And I saw a quote the other day, basically it said that the only engine of consumption in the next 2 or 3 years will be government. And I think there's something in that insofar as the post-COVID economic recovery, will have stimulus and economic stimulus at its core. And we at OCO, sitting between our government clients and our private sector clients, are plugged into this global agenda, are familiar with kind of what interventions and what stimulus kind of government at home and abroad are likely to make, and help you to use that to identify what post-COVID-19 opportunities are likely to emerge from that. And just to give you a sense basically of some of the clients, you'll see some familiar names here, I hope, in terms of Irish businesses, but also some of the clients who we've worked with recently across the world, spanning kind of multiple sectors. And on the right-hand side, you know, kind of just reiterating those services and those range of services that I've talked about already. So look, I've got 5 minutes in here and I haven't talked about COVID, which must be some sort of record for a presentation at this time. And I'm not going to spend an awful lot of time talking about the C word, but suffice to say, basically, you know, we have entered and are certainly sitting at the moment in a period of relative uncertainty. You know, the much talked about second wave is firmly with us. And the big question, I suppose, is what's going to happen next. And I'm not going to try and predict that in graphic detail this morning, but this is interesting, some data that I looked at a couple of months ago now, albeit from the Financial Times. And whichever way you look at it, if you look at it in terms of industrial output on the left, if you look at it in the context of, you know, some of the consumer measures, kind of on the right, employment in the middle, you know, we were starting to recover, and you can see basically in most cases, you know, those charts were beginning to go in the right direction after very steep falls across the spring and early summer. Of course, basically, if I were to run the data on again, basically look at the same charts for September, October, you know, clearly we would see a decline again. And that's really the, I suppose, a crossroads at which we find ourselves. And you know, as with me and others in the call, I'm sure we'll be feeling that, you know, kind of intently at the moment as you think about your own business. But look, if I can talk a little bit to opportunity, and just at a macro level here, you know, what I would say is that, you know, my own view and the view of kind of experts and people much more kind of eminent than I, is basically that the recovery here, you know, basically should, and in all cases will, you know, look different perhaps to what we experienced 10 years ago in the global financial crisis. You know, basically global trade actually had already started to rebound over the summer months and had a very different shape. I know we talk about U and V and various other kind of shape recoveries, but there's no doubt basically that whilst basically the dip was steep, the recovery, you know, has also been more positive as well. And just on the right hand side, and we look at this kind of pretty closely, you know, the consensus view actually is that the rebound in global trade and the rebound in global economic activity, you know, kind of looked at on a 2 to 3 year period, you know, kind of has every chance of meeting some of the more positive forecasts and outlook. So I think there's plenty, basically, if we take a medium-term view, basically to stay focused on. And I know that Luke and Henrik later in the presentation will talk about, you know, kind of some of the funding options, the range of options, and the flexibility of some of the options to support you in what hopefully will be a positive recovery for your businesses. Just finally, before I hand over to the other guys, you know, in light of kind of what's going on in the world, OCO have developed what we call 5 propositions to support companies with your post-COVID planning and growth. Firstly, we've developed a series of insight reports, which we call OCO Futures, that look basically at the high growth sectors that we believe will emerge and will be shaped by the post-COVID economy. Secondly, we've undertaken an awful lot of work with our clients in the area of supply chain resilience, so providing support on supply chain mapping, reconfiguration, and supplier and customer identification. Thirdly, as I mentioned, you know, whilst you can't travel, you know, we have people in those key markets across the world, and we're increasingly undertaking what I call surrogate sales activity, so providing on-the-ground sales, business development, and account management support to ensure that at least in some way you can keep close to your clients, even if you can't be with them sort of face-to-face or as frequently as you would be normally. And as an extension of that, we've developed a suite of digital services which we call Trade Without Travel, that basically allows you to gain insights and keep your business growing during COVID. And finally, you've heard about SaaS. You know, we think that we've stumbled upon a new acronym, which is CAS. And CAS basically is our knowledge as a service offer, which gives you on-demand access to research and market intelligence in all of those markets that I mentioned earlier on in the presentation. So without further ado, I'm going to hand over to Luke and then on to Henrik, basically, who can hopefully pick up, you know, some of the optimism, or let's say guarded optimism, that I've shared this morning and translate that into what that might look like for funding options for your business. Over to you, Luke.
You're on mute, Luke. There you go. You can all have a giggle at me now. Thank you, guys. Good morning, everybody. Thank you, Gareth and Killian. It's great to be with you all. My name is Luke Mooney, and I'm a director of the Duff Phelps corporate finance team based here in Dublin. I'll just give you a very brief overview of the firm for those of you who mightn't be familiar with Duff Phelps. We are a professional family of 4,000 people globally, and last year would have completed in and around 19,000 engagements last year. We have, almost 14,000 clients across the world, from SMEs here in Ireland through, as you can see there, a large percentage of the S&P 500. A picture paints 1,000 words, of course, and you can see our truly global footprint with our 100+ offices across 25 countries. In terms of how we assist our clients here in Ireland on a day-to-day basis, what I would say to you there is that we have a global valuation advisory practice, and that's led in Dublin by my colleague Niall Cribben. As you can imagine, he's been extremely busy in 2020, helping clients revalue corporate assets throughout the year. Also under valuation, my colleague Mark Sinnott runs our highly regarded real estate advisory group. And again, you can imagine through what's been 2020, he's been very busy advising stakeholders as to how to adapt and plan through COVID. I won't speak to corporate finance because myself and Henrik will deal with that in terms of funding international growth. So I'll just explain quickly about our significant compliance and regulatory consulting practice, which is run by my colleague Alan Keating. In terms of Brexit, you can imagine how busy they've been in terms of advising global asset management firms on Irish and Euro options. Our business intelligence and investigations unit, known as Kroll internationally, is run by my colleague Kevin Hart, and that's getting great traction. And of course, we have a very substantial restructuring practice, as active as ever under the leadership of Declan Tate and O'Dwyer and Brendan Hanratty. So as I begin this morning, my hope is that when this webinar ends, you go back to your companies and boards confident there is proven alternative funding options available to you as you consider how to execute your growth plans. And we've spoken about the impact of COVID on our society and economy, and 2021 is going to remain challenging, of course. However, there are reasons to be cautiously optimistic, and arguably Irish businesses are better equipped now to manage these challenges, especially with a thorough growth and integrated funding plan. Why would I be cautiously optimistic? The first would be our shared learned experience. Many of you joining us today survived and navigated the turmoil of 2008 and the recessions that followed. And I think those learnings to us all will be invaluable as we seek to grow our businesses in 2021 and beyond. The second reason for being cautiously optimistic is the ready availability of growth capital for Irish businesses, and that just wasn't the case back in 2008. The growth and maturing of the alternative capital sector in Ireland over the last 10 years has been very significant. As you can see from this slide, there are approximately 14 various funders actively deploying various forms of growth capital into the market here, and I haven't included standard bearers such as EIIS or new players like peer-to-peer lenders. And as you look at that slide, I'm almost positive that none of these platforms were either established in Ireland or in fact deploying capital in 2008. For the purposes of this morning, I'm not going to focus on our PE colleagues noted on the left-hand side, though they do, of course, play a critical role. Rather, I'm going to focus on the alternative lenders on the right-hand side, who in 2020 have continued to step up and partner Irish companies as they look to execute on their plans. The best way for me to demonstrate how the alternative lender community are operating in the market is to run you through a couple of very recent case studies illustrating how Irish SMEs are accessing this non-dilutive support to execute on their domestic and international growth plans. Before I begin, I'd like to say how pleased I am we're joined by Henrik Björklund of Proventus Capital Partners as one of our presenters today. Henrik and Proventus have been major supporters of Irish business, and Henrik, in terms of volume of capital deployed, is by some margin, I believe, the leading alternative financial partner to Irish corporates, having lent approximately 500 million to Irish businesses since 2012. And while Henrik is focused on larger companies, there are several established funders, as you can see here, supporting Irish companies actively lending in the 1 to 10 million levels. So I'll just run you through the case studies there. The first case study is a very interesting business. It was an early stage, high growing software as a service business. And we met them in early 2019, when at that point they'd gone from 0 to 3 million in ARR in the first 12 months. When we met them early in 2019, they were very keen to secure capital as quickly as they could. They needed certainty on that funding. They needed to reinvest in the business, and they had a very substantial pipeline ahead of them in 2019, and they were keen to get going. And initially, when they came in, they were thinking about equity capital as being their solution. Interestingly, when we asked them to put a value on their business, this particular SaaS niche, they confirmed was valued at, say, 10 times their ARR, or about 30 million, which is a steamy enough price for what is an early stage business. But really interestingly, they felt that 2019, if it went well for them at the balance of that year, they could get somewhere between 6 to 10 million in ARR, which would clearly have valued the business at 60 to 100 million. Though they were burning cash and not profitable, we felt, having assessed it, myself and my colleagues, Anthony, Sandra, and Aidan, we felt that they shouldn't give up equity unless absolutely necessary. So before formally assisting them with raising with equity, we looked to see if the alternative lender community could be interested in supporting this business. Fortunately, based on the quality of their software, the robustness of the contracts they had, and the fact that their first customers were global logos, this helped alternative lenders get comfortable, and ultimately they secured about 3 million euro in venture debt, which was non-dilutive. And the good news for that business is they substantially converted their 2019 pipeline by utilizing that alternative lender capital. And I'm pleased to say they created an awful lot of value for themselves prior to securing a formal Series A institutional fund round, which closed this year. So it's a great example of how people can use this capital to bridge a period of exponential growth. The second case study is a very different business. It's a mature services business. And our client here wanted to opportunistically take advantage of a failed sales process that had fallen asunder just as COVID began. So this case, we got engaged on it post-COVID, the first period of lockdown. This company believed if they could demonstrate certainty of funding, they'd be able to approach that disappointed vendor and do a strong value deal from their perspective. Now, our client here has very robust financial metrics, but the pillar banks just couldn't get there in terms of the support they needed to be credible in terms of approaching the vendor. Our pillar financing indications tapped out at, say, 1 to 1.5 times EBITDA. And while our client was generating very good free cash flow, it wouldn't have been prudent for them to use all of that. And they certainly weren't interested in taking in external equity at levels required to do the deal. However, again, the alternative lenders stepped up, and we secured funding offers at 2 to 3 times EBITDA. And ultimately, funding was completed, and our client unlocked what for them was a transformative acquisition without requiring any outside equity participation. The last case study, again, it has happened this year, so it shows you that the alternative lenders are keen to help, and it's slightly different in context because there is an equity element here. Our client in this instance had a very attractive, you'd nearly call it lifestyle business in the software and services sector. He was around a long time, and he'd asked us about valuing his business and ultimately exiting his business, but he accepted that to maximize his exit valuation, he needed to demonstrate stronger growth and scale to the market. Motivated by this, he came back to us within 6 weeks to say that he'd agreed to buy a business, literally just as COVID began. And we knew as his advisors that the price that he had to pay to get this business to transform his own profile would be challenging to fund. And we had to explore all options, including taking on institutional private equity. In this instance, we secured what's known as a unitranche solution, where an international alternative lender who has a lot of expertise in this client's particular area was able to put up debt of 3 times EBITDA, and the remaining gap that applied, that lender was able to take an equity position. And the key point to make there is that the equity dilution our client endured there was minimized because the alternative lender, of course, is making most of his or her target returns from the senior debt facility. So, you know, what would be our call to action to Irish corporates looking to execute their growth plans at home and internationally? I think it goes without saying that, you know, these companies should scope out all of the funding options available to them in Ireland, and they should be out there socializing their businesses and their plans for the future where appropriate with that alternative funding community. You know, what that will mean is that, you know, when they're ready to go, it could be an acquisition, it could be capex they need, it could be any number of key events, but when they're ready, then they're picking up warm conversations with potential financial partners rather than starting from scratch. And as we know, making friends early works well for everybody, as it ensures that the deal can be done more speedily and without any risk, or certainly reducing risk at financial close. So that's just to give you an advisor's sense at the lower end of the market as to what people are doing with alternative capital even now during COVID. And I'm very pleased to hand you over to Henrik Björklund now.
Just before Henrik starts his presentation, Luke, thank you very much for your practical case studies and examples. And again, it's very encouraging to see some great deals being done during COVID, being a particularly difficult time. So thanks very much for that. And again, I just like everybody, if they have any questions, please submit those questions through the chat function, and we're more than happy to pass those questions around the panelists at the end of the presentation. So without further ado, I'll hand you over to Henrik. Thank you.
So thank you very much to the team at OCO and to Luke for having me here today. My name is Henrik, and I'm the Managing Director of Proventus Capital Partners. I'm not going to talk too much about Proventus, but focus on today's topic instead. However, I thought I'll just give you a short brief introduction to Proventus and myself, just so you know who you're listening to, or you know where I'm coming from, so that everything is put in perspective. We've been an active lender since 2005, and we're headquartered in Sweden, but invest equally across Northwestern Europe. We have done 125 to 130 transactions over the last 15 years. We have some 2 billion euros to invest, and the only reason why size is important is because it determines the quantum where you can invest. So for us, it is very difficult to lend less than 15, 20 million at a time. But then again, then we can stay with you throughout the entire growth journey up to 100, 150 million of debt. We've been active in Ireland since 2012, when we did the first loan to Gay Electric, the wind power developer. The two things that I think of as a lender when meeting new companies and when doing the loans is really the partnership approach, working as a long-term financial strategic partner to the owners and to the entrepreneurs and to the management team to help develop the potential of the company. Because ultimately, it's going to be good for the company, it's going to be good for us as lenders. And the second point just to bring out is the flexible approach. each company is different, and each loan agreement and each setup needs to be different and adopted to those specific circumstances. So you can't use a cookie cutter when trying to lend money. I put a couple of the logotypes down at the bottom of the screen just to give you a little bit of flavor for what we have done so far in Ireland. I mean, one being Mannheim Mushroom, which is the European leader in mushroom compost and mushroom farming overall, I would say, where we help them restructuring their balance sheet. Silverstream, we helped them get out of Nama a couple of years ago. Stay City is a leading European service apartment operator where we lend them money to buy out a minority shareholder. East London Pub Company, we're looking for growth capital. Technopath is a super cool pharma company based outside of Limerick, where we provided growth capital, but also helped one of the founders to buy out passive shareholders. Gale Electric, like I said, wind power developer. DigiWeb, it's a telecom operator that was on an acquisition strategy where we provided acquisition capital. And Prem is another service apartment operator, super good at what they're doing, who wanted acquisition financing to acquire more assets. So in all of these cases, the borrowers generally had 1, 2, 3 shareholders, or it's been in the family, and the money that we provided sort of came in, prevented the need to raise equity. The one thing, so as you see from here, we are quite sector agnostic. The one thing that we don't do is the ESG related stuff like alcohol, weapons, tobacco, and as it's Irish people, I have to point it out as well, we don't do property development. We think it's a specialized skill set, and we have to recognize that we don't have it. So that's one thing that we don't do, which would have been fantastic if in Ireland. I put together 3 case studies to demonstrate how this could work in reality, but I thought I just don't really know how much you know about capital structure rules. So I thought I just started with a very, very simple schematic overview, just to make sure we're all saying the same thing. I mean, just to outline the obvious, this comes with a massive health warning, right? You were going to ask me anyway, so I thought I just put in the cost of capital anyway. But to my mind, when I was doing that, I was thinking of a mid-sized Irish company with 5-10 million EBITDA. There's so many things that affect price and terms, but just trying to give some sort of high-level guidance that could be. So the cheapest thing you can get is grants, and may not be super relevant for most of you, but depending on what your capital is needed for, there are material grants available, and I actually been involved in a company that managed to raise over 100 million euros from EU in grants, so it is possible. The next one is bank loans. This is probably what you're most familiar with, right? Going down to your local bank manager and asking for a loan. And just to be very clear about it, I always view that us as an alternative lender is a complement to banks, not a competitor to banks. The bank can offer things that basically no other lender could offer. So if I look at the key things in a bank loan, they're likely to ask for annual amortization of the debt, which is going to reduce your free cash flow. They're likely to ask for financial covenants, which will reduce your flexibility. But they are very cheap, 2, 3, 4% perhaps of cash interest paid every quarter normally. They don't ask for any equity upside. So if your company profile fits the requirements of a bank, then it can work really, really great. Then we get into this sort of funnier vocabulary here, unitranche, which I expect you haven't come across before. Unitranche is actually sort of a mixture between bank loans and a mezzanine loan, where you will have financial covenants, just like with a bank loan, but here you will have a little bit more headroom on it. So you have a little bit more flexibility. There is no annual amortization, but you repay the entire loan at maturity. So it strengthens your cash flow in the same way that a mezzanine loan would. Price-wise, I would say that it's priced between a bank loan and a mezzanine loan. So I would say 6, 7, 8% would probably be the most typical thing. The next one is mezzanine loan, which, and now we're starting getting into the little riskier aspects of lending. So that could be companies that have a weaker free cash flow, for example, because you're reinvesting a lot of the profits into new products or into the development pipeline, or it can be very well-established companies with a solid profit and cash flow, but just asking, needing more debt. And mezzanine is probably the right thing. You most likely to have financial covenants, but not always. There's generally no annual amortization. Everything is repaid at maturity, so it's strengthening your cash flow. Interest rate may be paid in cash or may be rolled up on the principal amount. I would say that the cost for this would normally be 8 to 12%, but they can equally well be 10 to 15, depending on the maturity of the company and depending on stability of the underlying cash flow. But still, it is a non-dilutive, and I wouldn't expect to see warrants or equity upside to these instruments. Moving one step to the right, we have convertible loans, and this is, now we're getting into diluted capital. This is a combination of debt and equity, used for even riskier situation than a mezzanine loan. It is unlikely to have financial covenants. There is no annual amortization in there, so good for improving your cash flow. Funnily enough, interest rate is actually surprisingly low here, I would say, 6, 7, 8% in cash interest. And the rest of the return is expected to come from the equity upside. So the loan can be converted into to shares, or sometimes there can be some detachable warrants and stuff like that. So the idea is you get part of your return from cash interest and part of it from the equity upside. And the people advocating for mezzanine is that it's a win-win. If the company is doing good, the lenders will do good. If the company is not doing so well, the lenders will not do well. So their interests are aligned. And personally, I'm not in this space of investment, but I would say that the return expectations are probably 15 to 18% in this. And then of course the final part of the capital structure is equity, but I guess that's that's topic for another discussion. So moving over to some case studies, looking at what we have done so far in Ireland. The first situation, which I think could be quite relevant for many of you, is Gay Electric. So we met them in 2012 when they were one of the leading Irish wind power developers with a very large pipeline which they had developed over the last 5 to 10 years. So it was very valuable. They were thinking about, how do we capitalize on these great opportunities? What do we do? They basically wanted to build and own as much of the assets as possible, but that would cost a lot of money. So they basically had two choices. Either they could raise equity and then continue to build out their own pipeline and own it all, or the other alternative was to maybe sell off two wind farms, recycle that money as equity into the third one, and then own the third one long term. when we met up with them, we find a solution where we could actually lend them the amount they needed as equity. And over the years, we lent them, started with 5 million, became 20 million, and all the way up to 100 million at the end of the day. And the reason why it worked there was because there was a solid underlying value in that development pipeline. So having that sort of asset backing was key in that situation. And the most common theme here that I think we've seen in Ireland is really buying out minority shareholders. As companies mature, some of the shareholders, some of the founders perhaps may retire or become less involved in the companies. And we see from time to time that this can cause friction between the shareholders who stay in and working night and day to improve enhance the value of the company, and the sort of the passive shareholders, which is in for a free ride, so to speak, of slightly generalizing now, given that they provided capital early on, etc., etc. But we see this as one of the scenarios where we get most questions in Ireland, actually. So if the active shareholders who wants to buy out the passive shareholders, if they have their own financial resources, great, end of discussion. But generally, it is difficult to have that amount of money available. So then the two most common thing is, they can either find another investor who acquires the shares of the exiting investors, doesn't really change the picture, you just replace one shareholder with another, or the new shareholder can provide the money to the company and the company can repurchase the shares of the exiting shareholders. Given the right circumstances, we have many times managed to lend money to the company, which the company can use to buy back the shares of the exiting shareholders. So let's say, for the sake of argument, that you own 50% of the company, you have two other shareholders owning 25% each. If the company buys back their shares, you will automatically own 100% of the company. So the company is now more indebted, but you will have 100% control over the shares. It is a little bit technical. You need to set up a new holdco, and it involves a small amount of tax planning involved, but it is quite standard these days. For this to work, I would say that the underlying company needs to be pretty stable. This is some sort of good visibility on the cash flow. I think it's important to do this. But we have done anything from 30% of the shares that enable the company to buy back up to 60 to 70% of the shares. So for the right circumstances, it can be very, very useful. And coming back to what Gareth and Killian were talking about before, the international expansion. We were working with an Irish company which had a good solid operation, I would say, in Ireland, and a small international outpost, small international presence, and they were looking to grow that, and saw really great potential in that. So, but unfortunately, they didn't have more money to inject internationally. So, they went to the local banks, and the bank said, yeah, we agree. You're a good company. You have good assets and good cash flow, so we can lend you more money, but only if the money stays here in Ireland. If you do your add-on acquisitions or investments in Ireland. So then they went abroad and talked to the company where they were, to the banks where they were setting up the new companies, and basically those local banks said, yes, you've done well, and we like what you're doing, but basically all your cash flow and all your assets are in Ireland. So we suggest you go to Ireland to ask for the money. So basically, both countries were pointing at the other one. As a cross-border investor, we are quite agnostic, where the money are invested, if it's in Ireland or the other country. so we could easily solve this inherent geographical conflict. The key thing here is you need to be able to move money between the two countries, right? So it needs to be almost fully owned, so you can do group contributions and stuff like that. But if you can do that, then it is quite feasible to look at this from a high level perspective rather than getting bogged down into the local problems. And I thought, yeah, just to finish before we go to Q&A, I just wanted to share. I thought, my own personal views, what I would think of if I were to borrow money for the first time. And I think my first recommendation would be get a lawyer. It's going to cost you a little bit of money to have someone who's working on your behalf, going through the agreements, the loan agreements and what have you. But it risks costing you much more if you don't have one. And the second one would be to do deals and to do business with people you trust. The problem is that anyone can be nice and be pleasant to run for a couple of meetings, right? It's really in the face of adversity and when you come up against challenges, you're going to know, did I choose the right partner for my business? So of course you don't know that when you're still in the courting phase. But I would urge you to talk to as many of the references as possible. The true color of the lender will come through sooner or later. Talk to take references. And the third point I would really argue is don't focus too much on interest rate. Of course, interest rate is important and shouldn't be neglected, but it's not on the top 3 things to ask for. It's much more important that you have the flexibility to run the company that you see fit. Not have too tight financial covenants, not have too high annual repayment, because that's risk losing, reducing the overall value of the company much more than the additional interest you paid. So that was it for me. So thank you very much for listening, and leave it back to Killian.
Henrik, thank you very, very much. Very impressive portfolio of companies that Proventus have been working with, and I think as well, very, very interesting case studies, very practical, and I think it covers quite a lot of scenarios that companies come across. And also, I suppose the advice that you give at the end is very practical, and I think we all can take a lot of that advice on board. It's very, very valuable advice. And I suppose another thing that came across in your presentation was the complementary nature of the traditional, of your funding with traditional bank funding, which I think is very important to highlight also, and that the two actually run very much in parallel. So I suppose we've been getting some questions in. We have a number of questions, and I suppose the first question I'd just like to put to you, Henrik, just when you're still fresh in your flow there, and I suppose you talk about quite a lot of building these relationships and the lending opportunities. And I suppose one of the questions that we got in there was with regard to unwinding of these alternative funding arrangements. Is there any sort of example that you could give, and maybe some insights into how that actually works in a practical sense?
Sure, absolutely. Thank you for the question. I think that the two most common ways how we are paid back would be either being refinanced by banks, or that the company is sold, and then when you sell it, you sell it debt-free normally, and then the new owner will take up his own debt or fund it by equity. So those are the two most common things. And I think generally when we get involved as an alternative lender, there is a reason why it's not suitable for banks at that point in time. So part of our strategic value that we can help the companies is making sure that in 3 or 4 or 5 years, the idea is they should be so good, you should be, or the bank should fight to get you as a customer, and we have done something right.
Very good. Another question there as well, and I'm pointing this probably to you, Luke. And in your presentation, you highlighted how important it is to have meetings early and have these conversations early, and obviously it has to fit in within the strategic plan of a company. What criteria would you consider important for companies to sort of, I suppose, think about prior to maybe contacting yourself to have a conversation? Is there anything practical there that you would maybe just highlight?
Yeah, I think people, Killian, more and more are prepared to look beyond traditional debt. And Henrik's right; it's the cheapest funding you can get. If you can get it, and then the other option that's most obvious to people is private equity. So when people are looking to execute on an event or to consider how best to fund international growth, right? I would just say for people to be open, right, and to essentially be open to the fact that you can work with people in a slightly more different in a different way to you might expect. I think Henrik has talked about complementing the pillar banks. Well, of course, alternative debt also complements private equity. It's what I would really say to people is go into processes with an open mind. I mean, the last case study I referred to, that they got a 40% uplift in value when that deal closes. And they just couldn't have done it unless, they'd never borrowed money from alternative before. So they had a lot of internal hurdles to get their head around. And I think the other thing, Henrik hit the nail on the head. It's something we do as a matter of course is, go and speak to the other portfolio companies. Speak to one where it worked for very well. Speak to one where they're having a middle of the road outcome, and speak to a portfolio company where it didn't go well, and get that data. So as alluded to earlier, that when you make the decision, you have a very good sense of how people are going to behave if and when challenges happen, because they will happen.
That's very good advice. And I think keeping your options open and keeping an open mind are very simple but important pieces of advice. Another question in, and to, I suppose, either or both of you, what role do you think invoice financing can play, particularly off balance sheet funding? We're seeing deals currently in the market of between €500,000 up to €10 million. So have you got maybe a view on that, Luke or Henrik?
Henrik, I'll just give you some current thinking onto what I'm saying. Typically at the lower level, Henrik can sometimes be more accommodative because the credits tend to be bigger, Killian. But at the lower level, certainly initially, some of the alternative funders don't want any other lender in there ahead of them, because they are providing a stretched amount of debt typically. Now they're being paid for that risk, but they are putting more capital to work. And what they don't want is to have some, we call it a nervous Nelly, capable of upsetting the apple cart if there's a wobble, because as we pointed out, there's nearly always wobbles as you seek to grow businesses. So what can happen is that maybe for a period when an alternative lender comes in, they might effectively be no invoice discounting, which I know doesn't work for people, and it can be a deal breaker. But what the alternative lender might do is they might come in and for the first 6 to 12 months, there'll be no invoice discounting. They will provide facilities to help the company with that capital gap. But when they're comfortable and everyone's comfortable with each other, they may allow in invoice discounting thereafter. And there are other alternative lenders, Killian, where it's not such an issue. I don't know, Henrik, have you anything to add on that? Or?
No, but I think it is a really good source of funding early on in the company, right? Because that doesn't mean, in that sense, you actually get the credit worthiness of your customers rather than getting too much focus on yourself, right? So especially in the first years, that's a super good way of funding yourself, I would say.
Okay, thank you. That's great. I suppose I have a question just for Gareth. And I suppose again, and Henrik, you touched on it in your presentation there also. And I suppose Gareth, just from your own experience in terms of companies investing internationally, you know, have you any practical advice, I suppose, in terms of what their perception will be in terms to the costs involved and their budgeting? And I suppose Henrik has touched on Proventus's ability to lend cross-border, but just from your own experience, Gareth, have you any particular advice you'd like to or insights you'd like to share, please?
Sure, Killian. Look, I think a common theme of both Henrik and Luke's kind of guidance is, you know, one of, you know, looking at your options and doing your homework up front. And I think that applies, Killian, you know, to the non-financial considerations as much as the financial ones. You know, if I had a dollar for, you know, everybody who gave me a bit of advice on a plane or at an airport, I probably wouldn't be on this call this morning, you know. And I think there's something in that in terms of, you know, everybody will have a view, and you'll have no shortage of people, you know, kind of offering that to you. But do your homework. And you know, the other thing I'd say is that, you know, this maybe is not the most popular answer, but whatever you think it's going to cost, probably double it in terms of some of your early expenditure around business development, around, you know, some of the upfront sort of research, and actually, you know, just be prepared to commit to that and sort of and stay the course. And again, you know, probably the biggest you know, source, I would say, of your businesses, or the biggest reason why businesses don't succeed, you know, kind of internationally, is that they don't stay the course. You know, maybe you know, they kind of, you know, have some early success, but don't stick with it. And I think basically that, you know, in international markets, which, you know, are a little bit tougher, you know, do require, you know, more effort, you know, are not as straightforward in many ways as domestic markets. You know, that's staying the course. And, you know, to Henrik's point, having a set of backers that you're confident are going to stay the course with you and kind of be flexible and kind of, you're realistic about the ebbs and flows. I think all of those things are crucial.
That's great, Gareth. Thanks for that advice. And I've just one final question, and again, I'm conscious of time, and I'm aiming for within the hour. So just one final question, and I suppose again, just in the context of the economic times that we're in, and obviously there has been some good news over the last week on a number of levels, but particularly so in the development of a vaccine. And I suppose it leads into this particular question. Just the innovation pipeline is important for SMEs. And what are the non-dilutive alternative funding options available to Irish companies looking to grow their innovation pipeline internationally? Is there anything specific that companies, you know, that are available to companies, or is it more or less all of the above in terms of what we've discussed this morning?
I suppose just at a smaller level, Killian, say on the 1 to 10 million, I think if the to speak directly to kind of continued R&D and continued growth internationally, I think if the company is demonstrating enough potential in terms of its pipeline, if the logos that they've signed up as customers are strong enough, and the contracts that they've signed up are robust enough, you know, I think the first case study I refer to shows how companies can get non-dilutive capital to expand internationally if they can find a backer that gets their story and understands their area of expertise. And, you know, thankfully there are the alternative lender universe are very sophisticated people that you know, are very entrepreneurial in their own way. You have very flat structures. Like, you know, one of the reasons people love dealing with Henrik is he's been with them all the time. You know, when they've a query on the loan, they don't get passed to, you know, some other part of the organization. They deal with Henrik. And I think the reality is if you can build up those relationships and find the right backers, you can find non-dilutive capital to support you on your international growth journey and on the capex you need to get there, be it R&D or whatever else.
Thanks, Luke, for that. That clarifies it very, very well. Okay, we have, I want to thank everyone for the questions, firstly. I want to then just thank all our speakers this morning. I have to say, I definitely found it very interesting myself, very practical. And I'd like to thank Gareth for his input on the international aspect, and to Luke and to Henrik I think it was provided excellent insights overall, and I hope this information has been helpful for some of our listeners today in your own companies. And what I would say is, please don't hesitate to contact us. You've seen our contact details. We will share the webinar with you afterwards. It will have all the contacts on it. We're available for any queries or questions that you might have in the future. And I hope you can understand that we're very happy to help you all as well to embark on your financing and international journey. So again, a big thanks to you all for taking the time to join us this morning. And please stay safe and take care. And thanks again.
Thank you, Killian. Goodbye, everybody.
Thanks, everyone. Bye-bye.
Thanks, everybody. Bye-bye. Bye-bye.